Now we are looking at the last kind of section of this part of shares. We're looking at shares and taxation. This has got to do with paying tax on your capital gains and paying tax on dividends because they're both classified as income. So let's have a look. Income tax is paid in Australia on anything that you make an income on. Okay. You're allowed to get the first $6,000 tax-free, and this is called a tax-free threshold. So that's for anyone, okay? But you can only claim this once. You can only claim it on one job, and you get the first $6,000 free, and then anything from there on you start paying tax on. With shares, in terms of getting a return on dividends and also making a capital gain, they are both classified as income. So therefore, they're subject to income tax. The way it kind of works out is there's a table that is like a sliding scale, and you pay tax as you keep on moving up this little chart here. So, as you can see, for the first $6,000, you pay no tax at all. Then any money that falls between $6,001 and $35,000, you pay 15 cents in the dollar for. Cool. Then if you earn above that, anything between $35,000 and $80,000, you get 30 cents in the dollar for, and it keeps on going up to 38 cents to 45 cents. Now, this is only the money that falls within that bracket, not the whole lot. So if you make an income of $170,000, you don't pay 38 cents in the dollar for every part of that money. You only pay 38 cents in the dollar for any part that falls in that bracket. All the money that falls in that bracket is at 30 cents in the dollar. All the money that's in that bracket is at 15 cents in the dollar. Later on in the year, we look at how this actually works and apply it to your real life situation. But as long as you realise that as you go up, there's a sliding scale. Every question you get will have the information that you need to work out the tax payable. Okay? Right, so capital gains tax. If you make a profit on a capital item that you have, then you are entitled, or you have to pay capital gains tax, or CGT. So this is a profit. So if you buy shares and sell them a bit later and make a profit, that's a capital gain. If you buy houses and sell them later and they make a profit, that's also a capital gain. There are different rules for housing and vehicles and those kind of things. But basically, if you make a profit, it's counted as income, and that income is therefore taxable. Now, they seem to change a bit in terms of the tax rules and things, but generally, there are a few things that we need to know. The shares purchased before 1985 are not subject to capital gains tax, but then there's all these rules that came in around 1999 that talks about capital gains and using different ways of working out how much you actually have made. So there's either two models. They either look at the profit you've made and compare it to inflation to see how much your money's gone up in real value, or you can divide your profit by 2, which is called the discount model. So let's have a look. The indexation model, which is that one that looks at the money you have earned and compares it to inflation, tries to work out the real gain in terms of inflation. So, like as inflation goes up, your buying power of money goes down. So they take that into account to work out how much your capital gain is. The other way is that if you bought shares after 1999, which most of your questions will have, and hold them for less than 12 months, you've got to pay gain on everything. Okay, so if you buy them and sell them within a year, you've got to pay tax on every part of the profit that you've made. So that seems a bit, kind of rough. But if you have them for more than 12 months, the discount rule applies, and you can divide your gain by 2. So if you make $500 profit, you only have to pay tax on $250. Which is pretty good. So that's why they're encouraging people to hold money a bit longer in the shares and stop people from buying and selling to make quick gains. Okay, so let's have a look. Once a capital gain has been calculated, you pay tax at your marginal tax rate. So your capital gains tax comes from the capital gain that you've made times by the marginal tax rate. Now this might seem a little bit gobbledygookish as we go along, but let's have a look at an example. Fred purchased 3,000 AMP shares at that much, and blah, 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 blah. 9 months later, he sells them for $8.98. Fred's marginal tax rate is 42%. Calculate the capital gain, calculate the tax owing, and calculate the after-tax return. So these are the 3 things you want to know. Have you made a profit? If you have, what capital gains tax do you have to pay back, and then once you've paid it back, how much money have you actually made once you've taken the tax out from your profit. So let's have a look. First, we've got to buy the shares. Now, you're pretty good at doing this now, so that's a piece of cake. Consideration is $20,250. Brokerage is $405. GST is $40.50. Add the whole lot together, and you get $20,695.50. Brilliant. Now you got to sell them. So we sell them. You can see that you're going to make a profit straight away, which is pretty cool. So you've got a profit. You've got $26,347.32 when you sell them. So that's pretty cool. So working out your capital gain. Remember, your capital gain is your total return, take your total cost. So our total return is $26,347.32. We take away how much we paid for them, which is your $20,695, and you can make a profit of $5,651.82. That's pretty cool. So you bought these shares and sold them in 9 months. So you didn't hold them for longer than a year. So therefore, no discount rule applies. You have to pay tax on the full $5,651.82. So the next bit comes in. Capital gains tax is your capital gain times by your marginal tax rate. So this is pretty simple. Basically, you just grab the money you've made, your profit, and times by your tax rate. Because you didn't hold them longer than 12 months, you pay on the full amount here. The full amount is charged by 0.42, which gives you this much here. So you actually have to pay $2,373.76. So nearly half of it. Part C is your after-tax return. And that's your total return, which is your profit. Your total return, take away your total cost, take away your capital gains tax. So how much money you sold them for, take away how much money you bought them for, take away the capital gains tax. So 26,000, take away your 20,000, take away your 2,300, and you get $3,278.06. Now you might be going, well, hang on a tick, I've made all this money and I've only get $3,000. You still are making $3,000 in 9 months, which is pretty good. So you've got to realise that sometimes it does seem a bit unfair, but it does work out quite well. Now, as you can see, there are no questions here. There will be some more questions. I'm going to write some up and give them to you. So don't stress too much. You will get some questions on this, and it's pretty straightforward, so it's not too bad.